Hey guys, it's Sasha. As the stock market crash continues, inflation continues to go higher and higher, the Fed keeps on increasing rates, and a recession is now potentially looming on the horizon. The one question most investors will be asking themselves is, what do I do with my investments? We have multiple different effects, big effects, shocking the system at exactly the same time. And if you are looking at your investments, you might want to make sure that your portfolio is ready to weather the storm. In this video, I will talk to you about 7 different factors that are absolutely critical. Factors that could kill companies that you are invested in the next few years. Factors that could see your investment go down all the way to zero if the worst was to happen. Because make no mistake, after every major financial crash and a recession, there will be casualties. There will be dead company bodies lying around. Some companies, including popular household names, companies that you could never imagine disappearing, some of those companies will go bankrupt. Many of them will completely self-obliterate in some other spectacular way. This has happened many times before, and it will happen again. With every investment, there is always a risk of your investment going to zero, but there are a few things that you could check to try and reduce that risk for the companies that you're choosing to invest your money in. So let's go through them one at a time. I'm going to share some examples of some of the companies that suffer from some of these along the way as well. And to start with, one of the biggest problems that is going to start smacking companies in the face is the cost of servicing debt. Many companies have got used to carrying huge amounts of long-term debt over the last 14 years. Interest rates have been pretty much at zero, so it didn't really matter. You could have a giant load of debt sitting on your balance sheet, but it cost you almost nothing to keep it there. And the longer this artificially low interest rate sat there, the worse the problem got. Some companies got massively complacent and built up ginormous piles of debt. The problem is that as interest rates are now going to rise, so will the cost of servicing this debt. Some debt will be linked to the rate directly, so the costs there will start going up immediately, but most debt will be fixed for a period of time, and the poop will really hit the fan when they have to go and refinance it. And for many larger companies, the typical refinancing round will be somewhat like every 2 to 5 years on every package. So if you have many of these different debt packets to deal with, you're probably going to have a major refinancing or two at least every year. So with those types of refinancing deals, the impact is going to be delayed somewhat, but once you go and do that refinancing, the hit is going to be significantly bigger instead. The rates going up by 3 or 4% can already mean that the company starts paying out an order of magnitude just to service the debt. We're not even talking about repaying it. And if rates then go to say 10 or 15% in the worst possible scenario in the next couple of years, that could literally mean game over for anyone who borrowed through the nose over the last 15 years. Look at General Motors, for example. GM had total revenue of $35.9 billion in Q1 this year, and from that revenue they made $2.8 billion in net income. $2.8 billion profit in a quarter, in 3 months of operations. And if you then scroll down to the balance sheet, go and look at the non-current liabilities section. There is this $16 billion in automotive long-term debt, another $60 billion in GM financial long-term debt, and they owe $5.7 billion in benefits to their workers, and another $7.8 billion in pensions, and presumably those two are probably somewhat index-linked to something, and $14.6 billion on top of that in whatever else it is that is called other. So there is $105 billion in long-term liabilities sitting there, and they made $2.8 billion in profit last quarter. $76 billion of all of that long-term stuff is long-term debt. That debt will have servicing costs, and those servicing costs are now going up, and they're going up incredibly fast. If the interest rates were to say go to 10%, for example, then the cost of servicing just that long-term debt, if there was no margin on top at all, would already wipe out all of their profit. And the problem is that having a giant pile of debt in this scenario will probably mean that your credit is also going to get downgraded. So the cost of servicing the debt will increase because companies will charge you more interest to pay the debt because the risk of you not paying it back increases. And the cost increasing means you have to pay more money in interest. That means you wipe out all of your profits and you start losing money. Losing money means that you get downgraded even further. The cost of servicing the debt increases, and that can get you into a very, very bad spiral very, very quickly. Be very careful though when looking at these non-current liabilities, because often there are other things like convertible notes, for example, that are sitting there that will be bundled in with long-term debt into a total debt pile by many of the software or many of the tools that you use online. Some companies have a load of that stuff lying around, but remember that convertible notes and other things like that are not the same thing as debt, because those don't have servicing costs. They don't have an interest. Well, they do, but it's paid in shares. They don't have to be repaid. They just convert into shares at some point in the future, subject to some conditions. So there is not the same impact in terms of the company not being able to make ends meet as a result of having those things on the balance sheet. The next problem is one that will affect many growth stocks and early stage companies, and this is the effect of long-term discounting on the share price. This one isn't necessarily a killer all by itself. It doesn't really affect the business directly. But if we hit a long recession and inflation stays high for say 2 or 3 years, then any company that is expected to grow a lot over the next decade by investors and where the valuation is based on earnings in 10 years time really rather than anything the company's doing today, those companies, the valuations are going to be absolutely smashed. Some companies that I am invested in, like Palantir or Fiverr for example, are very susceptible, and this is why both of them have seen their share price absolutely destroyed in the last 6 to 9 months. There is a very real risk here as well though, not just the risk to the share price, but the risk to the businesses. These companies are typically not raking in huge profits or potentially are even loss-making, and both Fiverr and Palantir actually have positive operating cash flows, but the point here is still really important, because these kind of companies will often rely on issuing equity to raise funds in order to fund the growth. And if you go through 3 years, for example, where your share price is at rock bottom, you can be massively screwed. You either have to give up huge amounts of equity just to raise the sort of money that you need to grow, or you have to borrow money instead of raising it through equity because you are unable to do so. But then long-term debt is also going to be mighty expensive and quite difficult to get in the current market, or you have to not raise money at all and then you have to grow substantially slower than you otherwise would. And because these companies are valued on the growth really as the ultimate number, if they are growing much slower, that could be a massive issue in the long term for the share price. The next sort of company that you might want to be very, very careful with is a cash burner. I find these particularly interesting because most of the popular stocks on YouTube over the last couple of years fall into this category. This is the sort of company that is spending money hand over fist and is posting huge negative operating cash flows every quarter. The issue here is that if you don't have a giant war chest in terms of cash on hand, then you can run out of money ridiculously quickly. And in this sort of market, the first 2 problems that I was talking about are going to come and bite you in the ass when you need more cash urgently. You will struggle to borrow the cash in terms of debt because nobody will lend you the money because they are seeing what's happening with your business, and you'll also struggle to raise money through equity because your share price just got smashed to pieces. So these companies could find it very, very difficult to make it through. One good example to show this is Rivian, because you can see the issue clearly in their cash flow statement. They started the last quarter with $18.4 billion worth of cash, which is a lot, and that's because they just went public at the end of last year. They burnt $1 billion out of that in the last quarter on just the operations, and another $418 million on capex, so about $1.4 billion in total. So at the end of the quarter, they had $16.9 billion left, and their costs are probably only going to increase from here. But even if they do not, even just at this rate, they only have cash for another 3 years before they run out. And if they should start burning faster, they could very easily drop to 2 or 1.5 years or even less. Now, Rivian and Lucid are probably not going to be in trouble because Rivian has Amazon and Jeff Bezos funding them, and Rivian have the Saudi Arabian Public Investment Fund behind them. So both of those companies have a pretty much infinite supply of cash as long as these people are prepared to keep pumping the money into the ventures. But in both cases, it means there is likely to be a fair amount of dilution, and there is a very real risk that one day their funding might stop for whatever reason, and that could mean curtains, because they only have a relatively small amount of cash to live on because they continue making losses, and they're expected to continue making losses for several years yet. And talking Talking about losses, the next massive risk in this market is companies that are unsustainable loss makers. This one can be a bit more subtle. Not all companies that are losing money are necessarily unsustainable. And I guess it's kind of up for debate, and lots of people will disagree with me on this point, which ones are reinvesting in growth in a smart way and perhaps doing the right thing for their business, and which ones are just no-hoper companies that are forever destined to lose money. But there are plenty of companies that are the latter out there that have fallen into a trap of just being permanently unsustainable, it seems, and don't seem to have any actual plan or some kind of path to making a profit. Peloton is a striking example, especially because for the last 2 years, seemingly every finance YouTuber out there was shouting from the rooftops, telling everyone to buy the stock. In case you didn't know, Peloton makes the world's most expensive clothes hangers, but despite charging a few $1,000s for a treadmill, they still managed to lose a huge amount of money. And the numbers just don't show how this is going to change. Their operating expenses are 5 times their gross profit in the last quarter. And there is absolutely no trend in the right direction to show how this might shift over time. They had a massive sales boom that was absolutely unprecedented during the pandemic, but now that that massively one-off effect has worn off and it is not coming back, they are back to losing huge amounts of money every quarter instead. And recently Peloton have fired 2,800 staff, presumably because of this unprofitability, along with the CEO who was also let go, and the prospects are really looking bleak. And this brings me nicely to my next big warning, and this is businesses that had a huge, massive, unreasonable one-off boost during the pandemic that will now go away and never come back. Peloton definitely does fit into this category, but there are many, many others. Robinhood is another fine example. During the pandemic, record numbers of retail investors started investing for the first time, and there was Robinhood right there offering them completely free investing into whatever they wanted at just a click of a button. Completely free being the bit that is a problem if you happen to invest in Robinhood stock. There was a huge boom in user numbers and revenue and all that stuff, and everyone was drawing projections that were going to the moon saying they're going to have an infinite number of customers, and as a result, economies of scale will happen and they are going to start turning profits. But Robinhood's business model and valuation exploded purely on the back of the pandemic and stimmy checks and things like that. Now that all of that is gone, the future looks really tough. The company is losing money, and it is not really clear exactly how they are going to climb out of that hole now that investor interest is dropping, crypto has crashed, and the number of new users has plummeted. Another category that may suffer disproportionately during a long recession is companies that make luxury goods or goods that are targeting higher-end disposable incomes. The very, very top of the luxury market is probably not going to get hit all that hard. Billionaires and such don't really care too much about recessions. But companies making premium products that are absolutely not necessary or where the purchase could be postponed can get hit very hard. Apple is a great example. Sure, they do make fantastic products, but if we hit a recession, a prolonged recession, or even a depression, people will lose their jobs, real incomes will drop, etc., etc. Demand for new iPhones and MacBooks is going to drop mighty fast. You can skip a year or 2 years and keep using the same phone, the same computer that you have with a cracked screen. This trend can be very gradual and kind of hard to spot in the numbers, but over time, especially in retrospect, it can really look pretty disastrous and can really hit those sorts of companies very hard and affect the numbers. And the next really important factor to look out for is companies that can get massively smacked in the face by inflation. This can happen in a few different ways, and yeah, inflation will affect all companies, but some are likely to get hit much harder than others, especially companies that are unable to quickly change their pricing or have pressures or government reasons or regulatory reasons why they can't quickly shift their pricing. One example is airlines. These could get destroyed in a recession. It certainly happened last time around when there was high inflation and recession overlapping. A lot of airline revenue is earned well in advance of providing the actual service. And we now find ourselves in a situation where the cost of fuel has gone up massively. Servicing, parts, salaries, etc. are going up massively. Airports are increasing duties and things like that. But the tickets were already sold 6 months ago or 12 months ago or even longer ago because people have been postponing because of COVID. And there are these extra costs now because you suddenly can't fly over Russia to get to Asia and a bunch of other stuff like that. And the cash flow of these companies can get smashed massively if inflation persists because the long time gap between selling the service when the inflationary pressures did not exist and having to deliver them now can mean really, really bad news. Another category that can suffer with inflation is companies that sell necessary goods that are very, very price sensitive. Things like appliances, for example. Inflation means that you really need to increase your prices because the cost of your supply chain is going up, the cost of your salaries is going up, and if someone's washing machine goes and breaks, they really do have to go and buy a new washing machine because most people don't really want to live without one. But these customers will be suffering themselves. Their wages are stretching less, they are potentially out of a job, everything else like food is becoming more expensive, so they will become massively more price sensitive here, and this can be a really hard Mexican standoff between the producer and the buyer, and it can be bad news for companies selling those types of goods, and it can affect their revenues in a big way. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.